Renaissance Macro's chairman and head of technical research. Jeff, good to catch up with you. Obviously, very strong, almost vertical moves this week. In your reading, what was the setup in the China markets going into this news, and where does that leave us after this flash rally?
Yeah, thanks for having me, Mike. So a couple of things. We turned bullish on China back in the spring, and that was really based on a capitulation signal in some of our works. In other words, people had just had enough, and there really wasn't anyone left to sell. In our view, that did not turn into momentum. That did translate into a bullish trend, and then it just kind of went dormant over the summer, which was frustrating. But we stayed with it, and now we're starting to see that pick up. And I think, as much as anything, obviously there are some policy decisions that help catalyze this, but a real important setup for us is looking at where the sentiment was, what the flows were doing, and the ETF flows with China related were horrendous. I mean, people were selling, almost panic selling hand over fist, and there just isn't any exposure, from our estimates. And so just to get people back to a market weight, there really was this void that was created, and I think that's part of what you're seeing. We call this the acceleration wall, and I think that's part of it, which is just this vacuum that's created by the abundance of sellers over the last, month to 3 months, really.
The fact that you were seeing, that evidence of what people had been saying verbally about it being uninvestable and having, no reason necessarily to have much exposure. Obviously, this rally, I guess, would cause some kind of a rethink of that position, whatever you think about the, long-term sustainability of the policies themselves. So I guess dynamically and sort of behaviorally, how do things go from here in terms of, if you've been out of it, do you want to look for a reason why this is not sustainable, or is it going to be a chase?
I think you want to do just the opposite. I think you want to look for reasons why it might be sustainable, because that's really the contrarian call here. Look, I don't know if we'll end up being right or not. Let's say it's 50-50. But if we're wrong, I feel like the risk is very well managed. There might be 10% downside, but if we're right, there's probably 50% upside. And the one thing I would say, and we thought of this back in March, which, if you look back to 2009, right, when quantitative easing and some of the policy measures were in place, we heard the words uninvestable about U.S. equities, right? That's almost laughable now, 15 years later. We heard the phrase that policymakers were out of bullets, and that phrase, has come up several times in China. So, whether this ends up being a correct call or not, I don't know, but the setup is certainly most consistent with some of the big calls that we've had throughout the ages. And I'm very excited about what we're seeing from a sentiment standpoint, from the historical return standpoint, and the idea that policymakers are actually, kind of throwing anything at it to try to get this to stick. We can talk philosophically whether it's good in the long run or not. I get it. That's, kind of the way that works. But we set the philosophical side of it to the side and really just focus on the price action. And that price action to us is very bullish.